It's time now for an in-depth look at the markets on this Friday, and for that, I'm joined on the line by Dr. Kim Young-han, Professor of International Economics at Sungkyungkwan University. Dr. Kim, thanks for coming on today.
Nice to be with you.
So the IMF says the U.S. China trade war will cost the world some $450 billion. This is something that needs to be resolved. What's going on there now, and might the leaders find a way forward when they meet at the G20 later this month?
Well, at this moment, probably I think it is quite really difficult to make any concrete forecast on whether they can reach an agreement or not, since both countries do not really have a big incentive to make any significant concessions in the ongoing negotiations. For example, from the perspective of the United States, Trump kind of regime seems to regard that they have lost nothing from waging trade war against China, considering their strong domestic support for kind of tough measure against Chinese trade policies. And also from the perspective of Chinese side, it is something unthinkable for them to make real significant concession, especially in terms of their national sovereignty in deciding their domestic economic policies. So in short term, we can say it is really difficult for both sides to make any significant concession to reach an agreement. But we can say as time goes and as the negative impact of all these trade war can be felt throughout their economies from U.S. side with increasing inflation rate, mainly due to the price hike in consumer goods, and also some negative shock on the production side with increased kind of effective prices, then probably they might feel more strong political necessity to reach a kind of agreement and get out of this trade war. Before they reach that really kind of pressing political pressure to reach an agreement, I think they might kind of keep on still tough position from both sides.
Yeah, clearly the Trump administration thinks the U.S. can absorb a lot more of this impact than China can, and I guess the same it thinks is true for Mexico with these tariffs going to take effect next week, though according to Bloomberg, they're considering a delay. Why might that be, and do you think the tariffs will actually happen?
Well, currently probably we might say that the threat sounds like a threat for the sake of threat. When we consider the kind of highly linked production network between the United States and Mexico's, majority of the U.S. manufacturing kind of industries are heavily dependent on their so-called vertical production network with the Mexican side. So that kind of certain tariff. Currently, they have threat to impose 5% tariff starting from June 10th, and then also they predict if it is not resolved, that they also threaten to increase the tariff rate to 25% in coming October. But if those tariffs are really realized, well, 5% tariff might not be that devastating, but in case of 25%, which has been threatened to be imposed on October, that's, we can say, a kind of suicidal measure even to U.S. economies. So, well, personally, I think it is highly unlikely that this kind of threatened tariff can be really kind of activated.
Well, in the meantime, we have Fed Chairman Jerome Powell seeming to hint that interest rates might be lowered at some point. Then yesterday, the European Central Bank said it's going to keep its key rate at 0 through the first half of next year, so trying to keep this growth going. Do you think is this monetary easing going global now?
Yes. When we consider the so-called background for all the so-called monetary easing approach, especially considering the U.S. economies, well, we can say U.S. economy is the only single economy on the whole global economy which makes some significant economic trends of the economic growth. But when you look at the details of the real economic performance of the United States, lately we can observe lots of negative signals implying that the current kind of economic boom cannot be really sustained, or sometimes it seems quite shaky and volatile, since current economic boom is mainly based on the earlier kind of monetary easing policies. So Fundamentally, I think that no economies on the global economy currently has any real kind of incentives to take any contractionary monetary policy. So, as we predicted, it is highly likely that this kind of expansionary monetary policy trends might be adopted throughout the whole economies at current kind of situation.
Got it. Well, Dr. Kim, that's where we'll have to leave it this afternoon, though. Thanks for being with us. We appreciate your insights.
Thank you.